journey and you're theirs too. I swim with tea when they turned in. The staring out to mute and can lend a pole that some key died.
When many people think about investment income reporting, they immediately think about T3 slips, T5 slips, and year-end tax preparation. But in reality, investment tracking begins long before tax season arrives. The Trident Investments case study demonstrates an important principle. Investment accounting is a year-round process, not a year-end process. Let's follow Trident Investments throughout the year. In January, the corporation purchases an investment, such as a mutual fund. At that moment, the first supporting document is created, a trade confirmation that records the details of the purchase. A few months later, in March, the investment begins generating interest income. The corporation receives interest, and another supporting document is produced, such as an account statement showing the income earned. In June, dividend income is received from investments held by the corporation. Again, supporting documentation is generated, such as dividend notices and brokerage reports. As the year progresses, additional investment activity occurs. In September, a mutual fund distribution may be allocated. This distribution could contain interest income, dividends, capital gains, or return of capital components. Supporting reports are required to identify exactly what was received. Then later in the year, an investment may be sold. When that happens, gain or loss information is created and documented through trade confirmations and gain and loss reports. Notice what is happening throughout the entire timeline. Every investment transaction creates a supporting document. Every purchase, every sale, every dividend, every interest payment, and every distribution leaves behind evidence. Those documents become the foundation of the investment tracking system. Over time, Trident accumulates brokerage statements, trade confirmations, dividend reports, distribution reports, and gain and loss reports. These documents are organized and stored throughout the year, creating a complete record of investment activity. This organized record-keeping makes year-end accounting and tax preparation much easier. Instead of trying to reconstruct an entire year of transactions during tax season, the corporation already has a complete history of what occurred. The key lesson from this slide is simple. Good tax reporting begins with good record-keeping. Investment transactions should be tracked when they happen, not months later when tax slips arrive. Remember, every investment activity creates a supporting document, and those supporting documents become the foundation for accurate accounting records, accurate financial statements, and ultimately, an accurate T2 corporate tax return. That is why successful investment tracking happens all year, not just at tax time. In the previous slide, we saw that investment activity occurs throughout the year, and that every transaction creates supporting documentation. The next question is, how does all of that information move from the investment portfolio into the accounting records? This slide illustrates the investment tracking system used by Trident Investments Inc. Let's start on the left side. Trident's investment portfolio consists of several different sources of investment activity. These include GICs that generate interest income, stocks that may pay dividends or experience price changes, mutual funds that produce distributions and capital gains, and other investment holdings that generate various forms of income. As these investments operate throughout the year, all activity is captured inside the brokerage account. Think of the brokerage account as the central hub of the investment system. Every purchase, every sale, every dividend, every interest payment, and every distribution is recorded there. The brokerage platform continuously tracks market values, holdings, transactions, and investment performance. Because all activity passes through the brokerage account, it becomes one of the most important sources of information for the accountant. From that brokerage account, a variety of reports and documents are generated. Monthly statements summarize account activity. Transaction reports show purchases and sales. Dividend reports identify dividend income received. Gain and loss reports track investment dispositions. And eventually, T3 and T5 slips provide tax reporting information. These documents then flow into the accounting department. At this stage, the accountant reviews the information and determines how each transaction should be recorded. The supporting documents are converted into journal entries and posted to the general ledger. Once the transactions have been recorded in the general ledger, the information becomes part of the corporation's accounting records. Those accounting records are then used to prepare the financial statements, including the income statement and the balance sheet. One of the most important visuals on this slide is the bridge at the bottom. On one side is the investment world, where investment transactions occur. On the other side is the accounting world, where financial reporting takes place. The investment tracking system serves as the bridge connecting those two worlds. Without that bridge, investment activity would never make its way into the accounting records correctly. The key lesson from this slide is simple. Investment documents are not the final destination. They are the starting point. Their purpose is to provide the information needed to create accurate accounting records. And once those accounting records are complete, they become the foundation for financial statements, tax reporting, and the eventual preparation of the T2 corporate tax return. In other words, investment documents become accounting records, and accounting records become tax reporting. That is the core purpose of the investment tracking system used by Trident Investments Inc. We have now seen how investment activity occurs throughout the year and how supporting documents are collected and organized. The final step is understanding how all of that information is transformed into tax reporting. This slide illustrates the complete journey used by Trident Investments Inc. Let's start with the first stage: investment activity. Throughout the year, Trident earns investment income from various sources. The company may hold mutual funds, stocks, GICs, bonds, and other investments. As these investments operate, different events occur. Interest is earned, dividends are received, mutual fund distributions are allocated, investments are purchased and sold, and capital gains or losses may be realized. At this stage, the transactions have occurred, but they have not yet become accounting records. That brings us to the second stage: supporting documents. Every investment transaction generates documentation. Trade confirmations record purchases and sales. Monthly statements summarize account activity. Distribution reports provide details of mutual fund allocations. Dividend reports identify dividends received. Gain and loss reports track investment dispositions. And eventually, T3 and T5 slips provide tax reporting information. These documents serve as evidence of what occurred during the year. The third stage is investment tracking. This is where the information is organized. Transactions are entered into tracking schedules, spreadsheets, or working papers. Income types are identified, amounts are categorized, and the accountant creates a clear record of all investment activity. Once the information is organized, it moves into the fourth stage: accounting records. The accountant prepares journal entries and posts them to the general ledger. At this point, the investment activity officially becomes part of the corporation's accounting system. The fifth stage is financial reporting. The accounting records are used to prepare the income statement and balance sheet. These financial statements summarize the corporation's financial performance and financial position for the year. Finally, we arrive at the sixth stage: tax reporting. Information from the financial statements, along with supporting tax documents, such as T3 and T5 slips, is used to prepare the T2 corporate tax return. The result is accurate tax reporting and compliance with CRA requirements. Now notice the warning box on the right side of the slide. It highlights an important risk. If documentation is missing, income may be missed. If income is missed, reporting becomes inaccurate, and inaccurate reporting can lead to reassessments, penalties, interest charges, and compliance issues. That is why documentation and tracking are so important. The entire process depends on maintaining complete and organized records. The key lesson from this slide is simple. Tax reporting is the final output of a much larger process. Before a number appears on a T2 return, it must first pass through investment activity, supporting documents, tracking systems, accounting records, and financial statements. Each step depends on the accuracy of the previous step. If the foundation is strong, the final tax reporting will be reliable. And that leads us to the most important takeaway from the Trident case study. Good tax reporting starts with good investment tracking. The better the investment tracking system, the more accurate the accounting records, the financial statements, and ultimately, the corporate tax return.